There is no doubt the macro environment is starting to look better for the traditional and cryptocurrency markets. The US dollar falling, bond yields dropping, the perfect storm is being created for a continuation upward. However, we do have to keep in mind that while the prices remain in their bear market structures, a move towards a downside and even potentially lower is still likely. Let's go ahead, dive into the charts and do a macro analysis today. Okay, welcome back to the channel, MegaWhale team. Thank you for tuning into today's video. Hope you're all having a fantastic day. We're going to go ahead and take a look at Bitcoin today. We're going to be focusing a little bit more macro today, talking about the macro structures on Bitcoin, traditional markets. We're also going to take a smaller time frame just briefly to talk about the current price action and elaborate on yesterday's video where we talked about a possible bull trap developing above that $17,000 level. So we'll talk about the progress of the short term, we'll go expand from yesterday's video, and also talk about the Fed pivot, the Fed hike coming up in 12 days, I think, and the effects those can have on the markets and the market direction. Now that the markets are in pretty delicate spots, we do need to start considering how the state of the economy, how the traditional markets are going to start changing and shifting, and thus how cryptocurrency can be positively or negatively affected. So let's go ahead and get stuck into it. Now, before we get stuck into it, head down to the pinned comment, click the second link, join our Telegram channel, get access to all of our updates, charts, analysis, information. So much stuff here, guys. All of our videos, news. Obviously, if you're interested in our VIP channel, you get access to our VIP channel here. All of our trade signals are posted with exact entries, explanations, targets, stop losses, everything you need to follow signals effectively here. You can find all of the information about our VIP in the free channel. Also, guys, smash the like button, hit the comment button, and subscribe to the channel if you are new. We do daily Bitcoin analysis and objective data, technical analysis, structural analysis, everything to do with the technicals and the price action we cover on this channel. Let's go ahead and start with our market data, however. So we'll start with the monthly. I think the monthly is a good place to start. Obviously, we closed out November at negative 16.23%. Again, November was quite a rough month. We did actually have the FTX fall down in November, so we saw that significant pull down from around the $20,000 range all the way back down to about 15,500, 15,800. So we did see quite a significant drawdown in November. It was down around 24% at one point, but it ended up coming back up later in the month, closing out a little bit more positive. And of course, December so far, we're down 1.54. Quarterly, 12.93. Again, 4 consecutive red quarters. Never seen this happen on Bitcoin before. But again, we're seeing a lot of things that have never actually happened on Bitcoin before on the macro chart, and we'll actually get into some of that later on in today's video. Volatility 4.13 as of yesterday. As of today, 4.12. Again, over a 30-day period, we're not seeing too much change in the volatility. A lot of plateauing here in the volatility. And this kind of goes hand in hand with the price action right now. If we actually take a look at the price action right now and look at the structures we're in this massive sideways consolidation. This is essentially a horizontal channel. It's quite a large horizontal channel, but it's essentially a horizontal channel here, okay? We have quite strong sideways compression. We had this below off top over here, potential breakdown. It looks like it was a fake out as of now. We do have confirmation that we have actually lost the $16,900, $17,000 support range. We are pushing down to this trigger. The next key trigger, guys, is this one over here at 16,800. If we fail to hold above 16,800, we can expect the prices to actually continue towards the downside. We'll come back to that in a second. And finally, volume and liquidations are quite low. As we can see, liquidations are sitting on that lower end of medium. Usually about 40, 60 is kind of mid-range. 100 plus is quite high. Anything below 40 is quite low. So we're sitting on that lower to mid-range of liquidations, indicating again with the decrease or plateau in intraday volatility, we can assume volume here is quite low. We said this yesterday, low volume and low volatility, especially with where the price action is currently, is not a good sign. We want a lot of volatility and a lot of volume pushing past these major resistance points. There's 20-day resistance here. We didn't quite get it, so it was a warning sign that we could potentially bull trap, and it looks like we have actually completed or started the beginning of a potential bull trap. So keep an eye on this one over here, that next target we're expecting down over here. Let's take a look at the traditional markets. So DXY has potentially found some support over here. I'll just bring my table up a bit. The DXY has found some potential support over here on this descending channel formation. Something to keep your mind on, something to keep a look at. We do have a triple bullish divergence over here. Obviously a triple bullish divergence meaning we have lower lows, okay, lower low, lower low, lower low, followed by higher lows on the RSI. Triple bullish divergences are quite uncommon on charts. You don't often see them, but when you do see them, they are not something you want to be ignoring. They do represent strong shifts or very strong discrepancies between the price action and the momentum, and those strong discrepancies can often lead to quite aggressive continuations, or rallies should I say, or reversals more correctly. So we can expect the DXY to potentially find some kind of degree of a reversal forming over here. Definitely with the Bitcoin falling and with the total crypto market cap hitting a medium time frame resistance, like we said, as we start pushing past these smaller moving averages, which is that 32 to 50 zone, we're more likely to find resistance between this level. We said in yesterday's video, we're pushing past the 32 moving average. We're going to start finding some resistance. If we do reject, we're going to reject anywhere between here and that 50 EMA. So we did actually find that resistance there. We did actually get the rejection. Dow Jones has actually pushed up, and it looks like we are topping out over here at the POC level. You can see this red line over here, the point of control. Along with that, we do have our bearish divergence on the RSI. So it looks like we could potentially see some degree of move downwards to around 33,000 maybe. Maybe if we do push upwards, we could see the DXY continue down, but we will actually need to see a break above this black line, which is 35,000, to see any sort of continuation upwards. This is where it gets interesting, guys. The S&P 500 is at the bear market resistance. We're going to talk a lot about the macro today. And this is why it's really important. That's why I'm spending a little bit more time talking about this morning, because the macro environment is in a situation now where we have the asset prices, particularly of S&P 500 and the DXY, coming, and the bond yield, sorry, which we'll get to in a second, coming to points of massive confluence. Really important points. Particularly with S&P 500 here, we're at a major downtrending resistance. This resistance is the upper resistance level of the bear market. This pattern here, this downward expanding wedge, okay, you could also call it a falling wedge or an expanding falling wedge. These are reversal patterns, of course, but this pattern is the bear market. This pattern itself is the bear market trend. So we are retesting the resistance of the bear market, meaning if we break above that resistance, the bear market, excuse me, has been flipped, okay? So very interesting point, but as we already know, guys, as we approach these levels here, these are major rejection points, and therefore we can expect some sort of rejection. We do have a rising channel forming on the S&P 500 too, which we do have to keep in mind. That is quite dangerous. As we approach these levels down here, we could potentially reject down to about 3,900 and potentially crash lower. So keep our eye on that. And again, the DXY is going to be very leading in what happens there. Bond yields are very interesting. 10 years have crashed significantly, very obvious, and the 2 years have actually just lost the 50 EMA. It's going to be very interesting to see what happens on this daily candle. We would really like to see this daily candle push back above if we want to see the markets fall back down. If we want to see this bullish strength continue, we want to see this candle remain underneath the 50 EMA. Again, we haven't lost the 50 EMA much. The only time we lost the 50 EMA was here in August 2020, which was when we had that fake out. And of course, the prior time to that was all the way back in September 2021. So we've been in this aggressive uptrend into 2-year bond yields for a very long time now. Anyway, guys, let's go ahead and talk about the short term, and then we'll get into our macro analysis. And I also want to talk about this question from one of our members. He asks, Whale, I want you to discuss the Fed pivot in your next video, even if for a minute. How will the Fed pivot impact the markets? So basically what he's asking is, how will shifting of interest rates basically impact the overall market? So we'll get into that later in the video, maybe at the end of the video. So short-term analysis of Bitcoin, we've kind of already discussed a little bit about it now. We said that we did have a potential bull trap going on. We had this weakening in the momentum. As you can see on the trend over here, this is our momentum trend. We had this rising momentum, rising price. We actually had a breakdown of the momentum a little bit before the price broke down. So you see where the momentum broke down over here was right over here in the price. If you see where the momentum did that support resistance flip, it was actually right over here. So we had confirmation that momentum was weakening. Okay, this was the uptrend for momentum over here. Okay, we had confirmation that momentum was weakening before we actually had that breakdown in the price action. And again, momentum and price, they go hand in hand. Usually price will follow momentum. That's why divergences are so effective when trading. So we saw that breakdown. It warned us, we do expect a breakdown of this uptrending support line for Bitcoin. We do expect this trend to break down. Now, going off this trend, we can expect moves towards the next supports. So we're looking for targets, okay, of these horizontal levels, this POC level, and this lower level here. Now, of course, there's no saying that these prices will be reached. There's not even saying that we're going to come all the way down here. We could push down over here, find support, create a new uptrend, and go down, okay? Go back up. So what it's saying is we're breaking this uptrend. We're going to either now develop a downtrend, which it looks like we are developing. We had that rejection. We've created that new low over here. It looks like this downtrend will take us to this level, potentially even lower if we lose through it. Or we're going to be pushing sideways or finding a new bottom before developing a new uptrend. Okay, so that is what we're looking at here. Again, we had a nice liquidity wick. As you already know, when we see these liquidity wicks, they generally occur before directional moves occur. So you're looking at liquidity wicks down over here. We're looking at liquidity wicks over here, even over here. They generally occur at the end or at the top of massive moves. So they generally indicate reversal points for the most part, as these big orders need a lot of liquidity to actually jump into the market. So they push it a little past these resistances, and that's why we see these big fake outs generally at the bottom or the top of most moves. So on the short term, I'm expecting it moves downwards for now. Before we even expect any sort of move to the upside, we do need to come back and start clearing these highs. So looking over this resistance level here, expecting a price move up over here will be needed before we start moving up. And again, our target for the upwards move is around 18,000 if we are able to get above. At the moment, with S&P 500 at resistance, the Dow Jones at resistance, with the DXY at support, we do expect more of a negative bias in the market direction for the next few days, potentially next 24 hours. So I will be expecting the prices to actually be more inclined to head down, including the fact that we have actually now broken out of the support line. Momentum is negative and the trend is now in a downtrend technically. We can expect more downside than potential upside. Upside again will occur when we clear this level, okay? That is what I'm looking at right now. So let's go ahead and get into the larger time frame. We'll stay on this chart for maybe 2 or 3 more minutes just to talk about the larger time frame on this chart, and then we'll go ahead and do some real big macro stuff. We're talking like weeklies, we're talking like monthly stuff. And we'll of course answer that question and talk about the interest rates and how it's going to impact the market, because we've had a lot of requests to do that. Let's go to a 4-hour chart. So 4-hour chart, we're going to go ahead and get rid of that line. As we can see, momentum has lost that 70 level. So generally we have the momentum or the RSI push above 70. We're in this overbought territory, and we only usually get that sell signal when we lose it again. So we're looking for those crosses back over that overbought signal into this histogram, this mid area of the histogram, to indicate that sell signal on the RSI. So again, the RSI on the larger time frame is of course bearish. We do have these bearish indicators occurring. So what we're looking at here again is a horizontal channel. Horizontal channel, we have this upper resistance here. We form this bull trap, this fake out, this first wave up, whatever you want to call it right now, it looks like a bull trap. And we do have that upper resistance or upper target here. We can see the VRPV is dropping. To the downside, if we want to see any sort of larger time frame move to the downside, we will need to lose this level. Losing this level here will result in a move down to about 39, or should I say, what am I talking about? 13,900, not 30,900. 13,900, guys, will be that next target according to the VRPV. That is, of course, this level over here. Let me go ahead and draw out 13,900. This corresponds with a pretty major support line on the larger time frame chart. Let's wait for the chart to load. It comes back quite some time. I think it's the top in about 2019 August, if I'm not mistaken. I might have to go to a larger time frame just for it to come into the chart over here. Not too sure why it's taking so long, but anyway, we can see it on the VRPV. We don't really need the price action to push up. We can see how it kind of jumps up on the VRP right over here before we have this drop down, and then we have a small little push up on the VRPV before we have this huge chunk again on the VRPV at 12,000. So we do have support between 13,900 and 12,000. If you watch any of my other videos, you'll see this. I don't know why it's not loading today, but you'll see it on the charts over here. So we do have this support range over here. That will be that expected bottom point if the prices do continue more towards the downside. But of course, there's a lot of stuff between here and there that will prevent that. Of course, we have these major support levels on the chart, these major horizontal support levels that we're looking at right now, indicated by these gray boxes. If we go ahead and zoom out even further to like a daily chart, what we can see is we do have this descending trend line over here. Now this descending trend line over here is quite interesting, as on the larger time frame we do have a bullish divergence. As you can see in the 1 day, we do have a rising RSI here, and we have a falling price indicating a bullish divergence. Also keep in mind the VRPV over here is indicating a nice little chunk of volume, so we're pushing back into it. We are unable to break through the resistance. As you can see, it kind of falls off at this point. And what that indicates is within this range here, we have a lot of support resistance. Within this range here, we don't have a lot of historical trading volume. And if we don't have a lot of historical trading volume within this range, it means we haven't spent a lot of time within that range. And that generally means when you see these little, when we see these peaks in the VRPV, followed by these smaller peaks and then immediate drop downs, these smaller peaks indicate points of which have prior or previously acted as major resistance, preventing the price entering these lower volume ranges. Hence why these ranges are lower volume, because if the price was able to enter those ranges, it would have increased in volume historically, and we would have seen these areas filled up with larger peaks. So that is what it's showing us right there. We do have a lot of resistance above us, and below us we do have a lot of support. So we're in this weird little spot right now between major resistance, major support. We have, again, a lot of resistance above us. If we even go higher up, we're looking at 18,100. We have a major market-wide resistance sitting around 18,100, which constitutes a lower and upper range of that June to November bottom area. This whole entire area here is major resistance. As you can see, the VRP starts to rise again over here, indicating huge resistance. So even if we start pushing through these levels, we can definitely get rejected or find significant resistance at that level again. Anyway, let's go to the macro. Looking for an honest, reliable, and accurate exchange that you can trust to trade on, go ahead and sign up to Bitget with the link down below and join myself and all of our other VIP members and other members who trade on Bitget daily. There's a whole range of benefits and features you can actually get by trading on Bitget. These include no government regulations, meaning you can sign up from anywhere in the world. There's no KYC, 0% trading fees on spot, massively reduced trading fees on futures. It's one of the lowest in the game. And most importantly, access to their protection fund. In case the exchange gets hacked, you can actually get reimbursed for your funds, so you can ensure your funds are safe. Now, most importantly, if you do sign up with the link down below, that first link, you'll get access to 2 additional features. These include access to a reward center where you can get up to $4,163 in rewards, and access to the MegaWhale exclusive referral link, bonus discounts. Every other month we do bonus campaigns. We get up to 10% off your trading fees, or even you get a percentage of your trading fees refunded to your account as USDT. Essentially, you get paid to be on the exchange. That's enough, guys. We'll get back into the video. So the macro is no doubt looking good. Now, I told this already, I said this at the start of the video, the macro environment there's no doubt about it, the macro environment is starting to look good. Not only for the S&P 500 and the bonds and stocks, like I said over here, but also for Bitcoin. Bitcoin is in a macro descending channel. Now, we know macro descending channels are bullish. They're bullish reversal patterns. So downward consolidations or bullish reversals occur at the end of it, meaning the trend flips from downward to upwards. All right, we go into an uptrend. Now, this pattern here is the bear market. This whole pattern here is the bear market. This pattern represents the Bitcoin bear market, or the cryptocurrency bear market, if you want to say, because Bitcoin does hold most of the dominance. So what we're looking for is a breakout of this downward diagonal resistance. When we break this downward diagonal resistance, just like on the S&P 500 chart, we're going to be out of the bear market. The bear market will have officially broken. And that really is the major trigger we are looking for. Because it's great to see short-term bullish indicators on a chart. It's great to see points of which you can take swing trades or scalp trades. But if we're looking for points of which we want to be looking to enter on the larger time frame, we're looking for the best possible entry based on the data we have, and that will be when the bear market breaks. So we're looking for a breakback over this 18,200 range over here, which constituted that bottom point we saw for about 4 to 5 months in June. Very obvious bottom, okay? If we do push back above here, this will be a nice fake out to the downside. we'll be breaking back above and we'll be entering a new uptrend, okay? Assuming we break out of this bear market resistance, what targets are we looking for? The next major target is we're looking for this 22,000, 24,000 crunch zone right over here, okay? Pushing through here will create a new macro uptrend. So the macro uptrend starts over here, and obviously breaking above this yearly resistance sends us into a new strong trend upwards towards 48k, okay? 48k is the the bull market resistance point, or a bull market trigger. That's what I like to call it, meaning that when we break 48k, we're into a new bull market. This is when we're going to this new parabolic rally, and it will take some time. There's no rush. This will take time. This is not going to happen in a few months. This is definitely not going to happen in a few weeks. This will probably take an extended period of time. Look how long it took for us to come down. It will take just as long for this momentum to start picking up, the market sentiment to turn around, and the prices to start rising to those significant levels. We're talking, 30, we're talking 48. But we could see these prices spin around on a short-term time frame much sooner than we expect if the trend does actually break this diagonal. Now, I did say, however, to start the video, until we are out of this bear market resistance, we do need to be open to the fact that we can expect more downward price action, because in reality, we are in a macro downtrend, right? If we're in a macro downtrend still, we have to expect down price action is still on the cards. So right now, we're not taking that off the boards. We do expect on the short term, if we come back down to these short-term support levels, like we said already, if we come down to these levels over here and we fail to hold above these levels, we will expect the price to continue towards the downside, 13,900, 12,000, maybe lower if we do break those levels. But for now, those are the levels we're looking at, okay? Let's go ahead and talk about the macro, the monthly. Let's talk about some of the stuff we haven't seen happen before on the Bitcoin chart. I want to go to trading view over here and just bring up the Brave New Coin Liquid Index. I want to bring up a few things I want to talk about that we haven't really seen happen before on Bitcoin. Then we'll go ahead and talk about that Fed Reserve and interest rate stuff. So let's go to the weekly chart. And I guess some of the big things that people were talking about, midway through this bear market, one of the big things people were really mentioning was the loss of the 200 moving average. So we'll go ahead and bring up the 200 moving average, because this is one that maybe a lot of people aren't aware of, or maybe a lot of people are aware of it, but you haven't thought about it for a long time, or maybe the newer people to cryptocurrency who came here between May, June, they haven't really looked at it. But the 200 moving average is something that, again, is something that we haven't seen happen before in Bitcoin. We've never seen the 200-day moving average actually be lost on the larger time frame. And this is quite a bad thing. Again, we don't really have a lot of data to go off, but what we do have is about 6 years of data where we've actually remained above that 200-day moving average for Bitcoin. And the 200-day moving average represents the strength or the average price of Bitcoin over 200 periods, okay? So that's what it represents. So generally when the price is underneath the moving average, whatever moving average you're looking at, what it's underneath the moving average, it represents weakness in the trend in comparison to the average price over a 200-day period on the Bitcoin chart. So what this is representing right now, we're representing weakness, okay? This represents weakness on the weekly chart in terms of where the price actually currently is in comparison to the average price of Bitcoin over a 200-day period, okay? Something we haven't seen before happen on the Bitcoin chart, something that I don't think I'm taking too much significance towards. Obviously, we have a lot of bullish indicators on a smaller time frame. Our market structures are bullish, but again, something we do have to consider because this is stuff that we haven't seen occur on Bitcoin. Another thing we haven't seen occur on Bitcoin before is an invalidation of the pi cycle bottom. Okay, I don't know why I'm bringing up this, the invalidation of the pi cycle bottom. Generally, we have seen the pi cycle bottom predict the exact bottom and the exact tops almost to the T. We're talking perfectly. As perfect as an indicator could be. There's always a degree of this error, but generally perfectly. We saw something very interesting this time around. We saw the pi cycle bottom predict the bottom at 18,700, but we actually ended up losing that level. So again, these are all things I'm concerned about because these are things we haven't seen occur before. And we can't expect every indicator to always be efficient. Not every indicator is 100% correct. So at some point, when you expand to a larger time frame, when you have more data points, some of those data points are going to start becoming incorrect, and that is totally normal and totally acceptable. All right. The difference is this time around is we're seeing on the macro, on the larger time frame, these indicators become invalidated, which we haven't seen before. So it tells us one thing, and that is how much confidence can we place in these indicators now that these indicators are proving to be untrustworthy on the larger time frame, okay? Particularly when we look at the 4-year cycle, particularly when we're looking at previous lows to infer where current lows should be, because this 18K prediction was made based on a lot of these prior moving averages and indicators we had in prior cycles, and obviously they got invalidated. So it's something we can't really expect. Another thing I do want to bring up is probably the thing that I'm worried about the most, which is a Gaussian channel, particularly the Gaussian channel on the monthly chart. And that is because we are pushing towards the midline. Actually, it looks like we have closed below the midline on the Gaussian channel. And as you already know, guys, the midline represents a key support, resistance, and trigger point for a price action in terms of macro swings. If we take a look at the weekly, generally every time we push into the Gaussian channel and break the midline, we end up below it. So again, over here, we push in, end up below it. Push in, again, end up below it. So it's a common trend in the Gaussian channel to predict macro swings. It's something I definitely am keeping my eyes on. Along with that, guys, there's a lot of bullish stuff on the macro chart too. Like we said already, we have bullish market structures of this macro descending channel, which is looking phenomenal, okay? We have divergences. We have divergences forming on the larger time frame. This is a very long time standing divergence. This is since June, July, August, September, October, November. We have a 5-month long bullish divergence, something to definitely keep our mind on. We have potential falling wedge structure developing over here. Okay, another thing to consider for reversal pattern, and of course we have this macro descending channel formation. It's not going to pop up on a log chart. If we go to a standard chart, you'll see it over here. So there's a few things on the larger time frame that are bullish. There's a few things that are on the macro to a monthly chart that are warning us we haven't seen occur before. So while we are staying in this bear market downtrend, we do have to expect downside is possible until we reverse that downtrend, we break that bear market resistance, we start heading up. Now, the interesting thing is macro charts are representations of what occurs on smaller charts consistently, okay? So macro charts represent what occurs on smaller charts consistently. So if you see a piece of data flashing on a smaller chart consistently and frequently, eventually it will sustain and be translated and represented on a larger time frame, meaning that just because the monthly chart is looking pretty bad, it doesn't mean it can't start looking better if the daily chart starts to look more bullish and push up, okay? The bullishness of a smaller time frame chart will soon translate to these larger time frame charts, okay? Remember, large time frame charts are much more smooth representations of the data, much more averaged. So when we have a year-long downtrend, of course the monthly chart is going to look aggressively bearish. And that is one thing that why I'm not taking those pieces of information into account, because we have a very significant downtrend. We have a displacement of money within this downtrend of significant proportions. We're talking, trillions. I mean, it was a couple trillions of dollars. We're looking at like $1.4 trillion worth of the Bitcoin market cap alone. So we're looking, and that's just Bitcoin. So the displacement of money in this cycle has been phenomenally large in comparison to other cycles. If we look at how much money was wiped off the markets in the 2017-18 crash, it was nothing compared to what we saw in the Bitcoin crash this year, even though the percentage was greater. So of course we're going to start seeing these larger time frame charts show us gloom and doom, death, destruction, and negative stuff all around. But we have to look at these middle time frame charts, these intra time frame charts, these dailies, 2 days, 3 days. Start looking at the structures, start developing some nice uptrends, and sooner or later that will start translating to the larger time frames. Anyway, guys, long video today. Let's go ahead and answer this community question. I'm going to keep it nice and short because I go into massive detail on this as we approach FOMC, as we can see FOMC in 12 days. We're going to go into huge detail on exactly how this impacts the markets, exactly what it means, all of the above, everything you can imagine we'll talk about. But I want to quickly just go ahead and briefly talk about it now. Very briefly to answer your question. You want to know how interest rates affect the market. So if we pivot, it means that interest rates start falling, okay? And interest rates don't need to be going negative to pivot. And this will get people to get confused. If we go from 0.75 to 0.5 to 0.25, we're pivoting, okay? Pivoting means we're turning around, okay? Say this is 0. Say this is negative, we're negative below it. we're gaining, we're positive interest rates, we're positive interest rates, we're positive interest rates, and then we start dipping. That is the pivot, okay? This is the pivot. This downward trend over here is a pivot. We don't actually have to cross back into negative rates to be pivoting, okay? We can pivot beforehand. Now, the reason the markets move on pivots or expectations of pivots will answer as well, okay? I think we'll answer that first. So the reason we don't need to see interest rates actually go negative before the markets spin around, we just need to expect a pivot, is because of something called perceived systematic risk. And we have seen the effects of perceived systematic risks in regards to expecting a pivot on the traditional markets. Look how the traditional markets have moved up, even though interest rates are still rising. In a sense that 0.75 plus 0.5 is still a jump up in total rate, okay? It's still an increase in total interest rates. So technically, the systematic risk of the market is still bearish, okay? So, perceived systematic risk is one of the main, if not the main drivers of price action in financial markets. And we'll use this chart to explain it. So generally when we have, I'm gonna go ahead and adjust this real quickly. Okay, so this is a complicated chart, but I want everyone to pay attention for 1 second. We have crypto, represented by C. We have the S, which represents stocks, okay? These are not connected. They're not connected, okay? Stocks and crypto do not directly impact one another. If the stock market goes up, the stock market doesn't cause cryptocurrency to go up. If the stock market goes down, it doesn't cause cryptocurrency to go down. They're connected by a commonality, and that commonality is the strength of the US dollar. The US dollar is what connects crypto and stocks, and it connects them to a degree of correlation of 0.7. Correlation, stocks and crypto, 0.7. So when the US dollar drops, we generally see the stock market rise, and we see cryptocurrency rise. Now, the rate of return on those rises are correlated to a degree of 0.7. So they don't rise by the same amount, and sometimes they don't rise at the same time, okay? Again, they're not perfectly correlated. They're 70% correlated. So sometimes we'll see stocks drop and crypto rise even when the US dollar is dropping. And we can see vice versa, okay? So you have to understand that they're not actually connected. If they're connected, they'd be perfectly correlated. There'd be a correlation coefficient of 1, not 0.7. So, perceived systematic risk is really important. And perceived systematic risk, what it is, we have to define systematic risk first. Systematic risk, which is this trend line here, okay, is interest rates, CPI, taxation policies, monetary policies, anything that can negatively impact or any kind of risk in the market that an investor, that you as a retail investor or an institution or whatever, you can't control. These are risks which occur in the market, which are basically strictly implemented by the government based on regulations and restrictions or taxation policies, or based on the economic drivers or the economy as a whole, okay? You can't edit them, you can't change them, you can't do anything about it. They're just reality, it's just what it is, okay? No one's been able to change interest rates. No matter how much you imagine you can try changes interest rates, as a retail investor, you can't do shit. You have to just accept it. It just is what it is. So this is systematic risk. So when systematic risk increases, okay? When systematic risk increases, we see the beta decrease. When the beta decreases on an investment, we see a more poor risk-return relationship, meaning people are less likely to invest, okay? Because the return and the risk balance shift, okay? There's more risk in the market as the systematic risk has increased in relation to the expected return, okay? And that's what that is. So now we have to factor in, why does the market move before the Fed pivots? Here's why. It's because the market moves primarily on something called perceived systematic risk. So this is the expectation that in the future, systematic risk will decrease and the risk return of the investments will become more favorable again. So what people do is they front run that. They say, I'm not going to wait for the systematic risk to become more favorable. I know the systematic risk is going to become more favorable in 4 months or whatever, because the Federal Reserve said they're going to pivot in December. Therefore, the perceived systematic risk in the market falls and people invest and prices rise. And that is exactly what we have seen happen in the markets for the last few months. And that is exactly what I've been talking about for a very long time now. So now, how does interest rates impact asset prices? Well, as CPI rises or falls, it gives leading indications on what the economy is, how the economy is responding to whatever it may be. And more importantly, what it tells us is it tells us what we should adjust our interest rates to either combat the rising inflation or reduce as the interest rates have been effective at bringing down the inflation. Right now in the economy, we have seen inflation decrease. We've seen inflation decrease. So we know interest rates are doing their job, bringing down this inflation. So there's no reason why the Federal Reserve will need to keep hiking up these interest rates by greater amounts each month. They can start pivoting. They can start bringing down the increments by smaller and smaller amounts as inflation drops and drops and drops. Now, when they say they're still aggressively fighting inflation, what that means is they do not intend, back over here, they do not intend on bringing interest rates to a negative. They do not intend on bringing interest rates to a negative. They intend on keeping it in this downward sloping positive range until inflation comes down to the desired amount, okay? So they can still aggressively fight inflation while reducing interest rates. It doesn't make much sense, but it can be done, okay, as described by that chart. So an interest rate decrease, interest on debt decreases, okay? Interest on debt, whether you have debt that you need to pay, whether it be house loans, car loans, for a retail, wherever for a company, it be loans that you've taken to acquire income producing assets, it decreases. But also, it decreases for new debt. So people who want to take out debt to acquire assets that produce income can do that. People who want to take on home loans to acquire houses or whatever assets, they can do that. So what that does is for people who have existing debt, they have increased household available cash flow. With increased cash flow, because debt obligations has dropped, they have more money to spend on assets. They have more money to invest, okay? Asset prices rise from the retail perspective. From the company's perspective, when interest rates are low, they acquire debt. They acquire a lot of debt to buy assets. Like they buy most of their assets on debt. What they do, they buy income producing assets. Those assets produce income. That income increases future cash flow earnings. That future cash flow earnings props up the stock price. The stocks go up. Okay, very straightforward. That is simply it, guys. If interest rates fall and pivot, asset prices rise. Hope you enjoyed the video. I'll see you guys tomorrow. Cheers.